Well, Art, thanks for joining. I'm going to spend a little bit of time just to pick your brain, if you will, and learn a little bit more about your views and insight on risk management. I think
That's scary.
it can be, but for guys like me, I love geeking out on it.
That's great.
So, for us here at CLS, I think a lot of times we spend an enormous amount of time looking at data and information and things that really characterize what we do in terms of risk budgeting. That's everything from looking at our risk budgeting scores every day for every single ETF we look at, all the way down to decomposing volatilities, tracking errors, things that a lot of industry practitioners would think about. So, why don't you just give us kind of your perspective on kind of what's been the evolution of risk management related tools and software?
It's a great question because if you turn back the clock, when I got in this business in the very early 80s, um, 81, I think, we concentrated a lot of time in early parts of my career, myself and my colleagues in the firms I worked with, and have had an opportunity to work with some of the big, good firms. A lot of time we've spent on managing for returns
Hmm.
and chasing a return tail. I think what went by the wayside, but became something that the industry generally realized they needed to change. What went by the wayside was not as much concentration on risk and managing risk and measuring risk, for that matter. And in 1987, we had good old the incredible Black Monday fall, which I remember it very distinctly, just watching things fall off a cliff. That was kind of the first time in my career, at least, that everyone realized, wow, risk has got this downside thing that's pretty ugly. And then we went through it again in the early 90s
Hmm.
and, on and on and on. And I think what's evolved mostly because of tremendous advances in using, in effect, laptop and desktop computing technology to enhance the understanding of mathematical properties and calculate risks and managing risk. We've really put risk at the forefront of what we do now. And candidly, returns are almost a byproduct of what you manufacture on a
Hmm.
risk basis. So, what I've seen evolve, and I think, particularly after studying what you do at CLS, CLS has cleverly flipped that coin over from where I saw it in the beginning of my career.
Hmm.
And you start with the premise that measuring and monitoring and controlling risk is really critical for the experience of the investor in your portfolio, and that your return stream actually becomes a byproduct, in effect, of what it is you're trying to manage risk wise.
Hmm.
And if you're measuring and managing the risk correctly, the return stream that you provide to the client actually gets defined by the amount of risk that individual wants to take within the guardrails, as I call them. And so the big, change that I've seen over time, and the thing that as it relates to you guys, is you've over time with the industry, as we've grown with better tools and techniques for measuring and monitoring risk, you guys flip that equation upside down.
Yeah.
And you've got your risk foot forward and your return foot coming as a byproduct of that. And I think that's very helpful for an investor.
Hmm. Yeah, that's quite interesting. I know, you know, for the way we think about things, we always feel that, if we're not really delivering on our risk budgeting promise, we're not adding value for a lot of our clients.